Okay, this is some revision for financial statements of sole traders. So if we do an income statement, you would first of all write the name of the sole trader at the top, or the name of the business if they're using a business name instead of their own name. And then the phrase we write is income statement for the year ended, and then put the date. So, I don't know, 30th of November 2019, something like that. Yeah, so this phrase is only different to the statement of financial position. Then we have our 3 columns, although you can get away with just doing 2 of them. And then right at the top, we have our revenue. So the whole point of an income statement is we're going to list all the income and all the expense to work out the profit for the year. Now, on the statement of financial position, we put the assets and liabilities. So income statement is just income and expenses. So revenue first, and we write that number right at the end. And then if we have any sales returns or returns inwards, that's another phrase we can use, we would subtract it from that number. Take it away, and that would get us our net revenue. Yeah, but I'm not going to label that. Then underneath, after we've got our sales, we then get our cost of sales. So our cost of sales, got a little formula, opening inventory plus purchases minus closing inventory. Now, there's a few little bits that make up the purchases, so that's why I'm going to use this column here. So first of all, opening inventory. And I'm going to put that in the middle, because it's not the final total. Then for the purchases, I'm going to use this column here, because there's going to be a few things that make up the purchases. So I've got purchases. Now, I could have returns outwards, which I would take away. So that's purchases returns. I might also have goods taken for own use. Yeah, now this is only for sole traders or partnerships that you can take goods for your own use. So again, I would take that away. And I would have carriage inwards. So delivery costs for the goods coming in. And that gets added to all the purchases. So I'll add that up and I'll put that in the middle column. Now, this bit here, you can get away without using this third column just by putting all this in the middle column and doing it all in one go. But I like to have 3 numbers here: opening inventory, the net purchases, and then closing inventory. So closing inventory. And like I said, we're going to take that away. So then we do this number, so opening inventory, plus all the net purchases, take with closing inventory, and that goes here, because that is our cost of sales. So we've got our sales, that's our net revenue, and that's our cost of sales, so I'm going to take it away. And this number here gives us a gross profit, or it could be a loss if that's negative, although hopefully most businesses will have that as a positive. And then after we've done that, so we dealt with the main income and expenses, the ones that link with our trading. So this used to get called the trading section. We then move on to the profit and loss section. So that's when we look at all the other incomes and all the other expenses. So we're going to add on any incomes. Now, if there's only one income, I can put it straight away at this end and just add it to the gross profit. But if there's a few, I'd have to list them. So the main one you will see is discount received. Yeah, you might not have all of these. You might have some, but not others. So discount received. Another one you might have, well, you could have something like rent received or commission received, anything like that. So I'm just going to write rent. Yeah, you could have interest received. Basically, if it's got the word received, then it's income. Yeah, you could have other ones that link to all the adjustments that you know about. So you could have profit on disposal of a non-current asset. So that means if you sell a non-current asset to a vehicle or an equipment or machine and you make a profit from it, then that will go on the income statement and the income. You might also have a decrease in provision for doubtful debts. So you could have put aside, I don't know, £500 for provision for doubtful debts, whereas this year it's only £400. So you kind of got that £100 back out of that provision. So if it decreases, it's an income. You'd add them up, of course, in the total column, add that with the gross profit to get our new kind of gross profit plus the income. Now, I'm not going to label that, but then I am going to take away any expenses. So less expenses. And again, the main one you'll see is probably discount allowed. Then you might have rent. And then normally, if they've got two different types of rent, they might call this one rent paid. You've got lots of different expenses. You could have a loss on disposal of non-current asset. You could have an increase in provision for doubtful debts. You might have irrecoverable debts written off. So that's the ones where a customer goes bankrupt. In fact, if you retrieve some of that money, if you recover some of that money, that could go here in the income recovery of irrecoverable debts. You might also have depreciation. Remember, that's just the yearly depreciation. So you wouldn't write yearly, just put that there to remind you. So just the yearly depreciation will go there. And then you might have lots of other stuff, so like telephone, salary, and then you might have a sundry expenses. So remember, sundry expenses, they're the ones where it's all the little things that are combined together. So contribution to charities, stuff like window cleaners, like small amounts get grouped together under the sundry expenses. Then you add all the expenses up, and that goes to the total column, and we're going to subtract that from our previous total, and that gives us our profit for the year, which you might see that called net profit as well. And we double underline it because we're finished with it. Yes, so some of these you might not have. You might have more, you might have less. Same with this. It's very rare you'll have lots of income items, but they're all the ones to be familiar with. Okay, so an income statement, like I said, looks at the income and expenses. And so the statement of financial position, or the SOF, that looks at the assets and the liabilities. So again, just for sole traders, it's slightly different from partnerships and limited companies. The phrase we use is statement of financial position. And the phrase we use here is as at, and then the debt. So the income statement is for periods of time, whereas a statement of financial position is at a specific point of time. So it's just a snapshot of what they currently have, what they currently owe. Whereas an income statement is during a period, during a year or so, how much have they received and how much have they spent. So we start this off, again, we've got three. We start off, let's have our non-current assets at the top. Now there's a couple of different layouts for this. I want to show you the one that I would use. And so non-current assets, these 3 pound signs work the same as they do on an income statement. However, they can work slightly differently for non-current assets if you've got multiple ones. So how they can work for this is we write the cost price first, then we write the provision for depreciation. That just means how much has depreciated so far, and then the net book value, or the carrying amount at the end. So it's just cost, take away the provision, equals net book value. So you might have vehicles. So an amount, take away depreciation, gives us our net book value. You might have equipment. So amount, take away depreciation, gives us its net book value. Then what you would do is you would total these up. Now, these two numbers I'm not going to use again, so I'm going to double underline them. But this one is kind of my total value for the non-current assets. So I'm going to leave that there, I'm not going to double underline that. The next section would be the current assets. Now, the order doesn't matter. However, when these were first done, they used to put the highest amount at the top first to impress people looking at these statements. So first of all, I'm going to write inventory. So, sorry, two rules there. So they normally put the highest amount, so that's when non-current assets went at the top, and then they would normally put the most liquid. So remember, liquidity is all about changing assets into cash. So inventory is your most liquid asset. Yeah, you can sell that very quickly to get cash. So inventory, I'm going to put that in the middle, just because it's not the total. So I'll go to the next column. You will also have trade receivables. Now, normally you just put that in the middle. However, I'm going to put it here because you might also have a provision for doubtful debts. So if you have a provision for doubtful debts, then you have to subtract that from the trade receivable number to get what we would call the net trade receivables. So you don't have to write that heading, but I'm just going to write it for you. So net trade receivables. So that just means how much our trade receivables owes, how much our customer owes, take away how much we think we're not going to get. We might also have other receivables. So that could be prepayment of an expense, or could be an accrual of an income. And then you might have bank and you might have cash. I'll put them both in the same line. You would write them separately if you had both. You add them up, and that would give you the total value of the current assets. So then what you do next is you add the current asset total with the non-current asset total to get our total assets. Now, doing this layout means that we don't have to worry about doing any subtractions. So this here, I'm going to double underline because that's my total assets. Then I'm going to look at my capital section. So I've got my opening capital. So at the beginning of the year, how much capital does the business have? Then I'm going to add any capital introduced. So if you put any capital into the business yourself, you would add that on. You would hopefully add on profit for the year. If it was a loss for the year, you would take it away. And then I'm going to take away any drawings. So that's money that you've taken out of the business for personal use. And that number there, once you total it, that will give you your closing capital, but I don't need to label that. Then we will go straight to our non-current liabilities. And if it's a sole trader, this could be a mortgage if it's for property, or it could just be a bank loan. So check questions carefully, check information carefully to see if it's current, so owed within a year, or non-current, so you don't have to pay back for more than the year, but longer than the year. Now, normally you just have one, but if you had two, you'd use the same idea here, total them up, and put it at the end. But I'm just going to assume we had one, put it straight at the end. And then finally, our current liabilities. You would have our most important one, trade payables. So again, that's going to go in the middle. It's probably not our total, probably have more than one. We might also have other payables. So that could be an accrual of an expense. So something we owe, or could be a prepayment of income. So something we paid, we received early, so technically doesn't belong to us. We owe back to them for that current year. We might also have a bank overdraft. And I guess you could also have a short-term bank loan. Yeah, you add those up. So you've got three totals here now: the capital, or closing capital, non-current liabilities, current liabilities. So you add them up, and that gets you your total capital and the liabilities. And what should happen is these two figures here, the total assets and total capital and liabilities, should balance because of the accounting equation. So that's allowed. So once in practice, nice and simple. So you hopefully should be used to it by now. We'll look at in a second common kind of adjustments.